Hello and welcome to the latest edition of Citrus Bites. So we've just had the latest Bank of England base rate decision, and maybe not surprisingly, actually, for most economists, we saw a drop of the Bank of England base rate from 4.25 to 4%, which is actually the fifth consecutive decline we've had. So to August 23 to August 2024, there was no movement. And then in that last year, we've now had 5 quarter point reductions. So a widely forecast reduction, but actually in the end, the vote was a historic vote because it was the first time the vote had to go through a second round of votes because it was deadlocked, it was so tight, and in the end it was a 5-4 vote in favour of the quarter point decline. So I suppose First of all, it's kind of, well, what is all the negative sentiment that perhaps made this drop no surprise at all? You know, why had we seen sort of in the mortgage market, fixed rates already declining predominantly in the run up to the Bank of England announcement? A few reasons that I talk about typically during bites. One is unemployment. So unemployment continues to tick up. We're now at 4.7% unemployment. And I think I widely speculate that, you know, really pounds in the pocket. So if people have money to spend, they have money to spend. If they don't have a job and don't have money to spend, that's a really quick way of impacting the economy. So unemployment has been ticking up very gradually now for the last couple of years. So that's the first thing to talk about, the unemployment level. What's causing it? Again, it could be a mixture of things. Obviously, we saw employer national insurance contributions increasing in April. The general growth of the economy is really flat. So a variety of things that could be causing it. Second of all, though, the pressure that eases is on average weekly earnings. So something else I've talked about now for a couple of years is how average weekly earnings continue to be really quite strong. Over the last few months, we're still seeing average weekly earnings going up, but the amount at which they're going up is absolutely cooling. And if you follow the purple line to the right-hand side, what you'll see is now when you allow for inflation, actually average weekly earnings are up by just over 1%. So that's kind of the last time it was lower than this was July 23. So we're seeing unemployment up. The number of vacancies in the market is down. It's down to below 750,000 now. Again, that's a figure that's been coming down consistently for the last few years. And we're seeing average weekly earnings cool. So all a sign potentially the UK, that not all is well in the UK economy, along with flat growth. So in spite of all of that, why was the vote quite so close at 5-4? Well, it's mainly because of inflation. Again, one of the other things we've talked about regularly. So core inflation is running at 3.7%, CPI, so standard inflation, running at 3.6%. Why is inflation running so hot? Few areas. Why is it happening? All sorts of reasons why. Potentially some of the analysis versus where we were last year. But actually a couple of things stand out. Really bad news if you're a tea drinker. So tea gets a special mention as being something that has seen a consistent uplift in price. And over the last few months, that's been very noticeable over the price increase for tea, meat. So food really is causing a sustained pressure on inflation. And the Bank of England will be very, very, very cautious about stopping inflation continuing to increase. I think the latest forecast is it will hit 4%. But obviously, remember, the target really for the Bank of England is 2%. That's the target they set. So we're going to be running at double the target. And reducing interest rates is not a great solution when you've got increasing inflation. So this is the levers they're trying to pull to work out how to get the economy firing. So before I talk a tiny bit more about the economy, I just want to say, so is this good news for borrowers? You know, widely speculated, great news. If you're a borrower, the Bank of England base rate has come down. Well, partly, I would suggest, because 85% of residential mortgages are on fixed rates. So fixed rates, typically when the Bank of England announcement is made, not much change to fixed rates. What's changing in fixed rates? There is some good news. So for those people that locked into a 2-year fixed rate back in 2023, actually, particularly around August 2023, they're experiencing that really kind of significant spike we saw in interest rates. We were seeing 2-year fixed rates, kind of 75% lending in the high 6s typically as an average. wind the clock forward to 2025, and we're now seeing those rates in the 4s. So actually, if you're coming to the end of a fixed rate, yes, it's positive news. Obviously, if you're on a 5-year fixed rate, you're in the middle of it until you come to the end of that, not much change. If you are one of the kind of 6% or so that are on a base rate tracker, then good news, you should find typically the lender makes some change to that very quickly. So there's a few people that will see very quick benefit from the Bank of England base rate change, but actually the vast majority from a fixed rate perspective won't see that change yet. So the final thing to talk about, I figured there was so much news, we don't have time to talk about tariffs and everything that's going on there. The one thing I did want to touch upon is, so what is the Chancellor going to do, which is getting a lot of press right now? We've been told there's about a 40 billion deficit against the government's own fiscal rules here in terms of the government spending more than they can. They've got the economy, which is proving to be not very resilient. It's really flat in growth. I talked about the numbers earlier for unemployment, for average weekly earnings. So widespread speculation around, are they going to have to undo their election promises around where they would raise money from in the event they needed to? And I just thought this last slide that I'm going to show brings it into a bit more context. So the 4 key ways from a taxation perspective the government raises money, you can see in my pie chart, there are really clear ways it's done. The majority of the money is coming out of income tax, it's coming out of national insurance, it's coming out of VAT, and it's coming out of corporation tax. And the problem is that actually, if you don't touch these, then what are you really going to touch? We've already seen some corporation tax changes, but what is the government going to do? Because if they don't touch income tax, if they don't touch national insurance, if they don't touch VAT, the other things they're touching represent such small pieces of this pie. So you can sort of play with them a bit if you like, if you want, whether, there's been a lot of speculation, would it be kind of gambling that sees an extra tax, or oil and gas that starts to experience an extra tax? But if you look at the amount of money that raises, the question I have is it really going to generate that 40 billion, with an extra airline tax, things like that? So that's the big question mark. Will they have to go back on their election pledge and actually raise the taxes they said they weren't going to? But that's the dilemma they face. And you can see now how much they are reliant on those things they've said they won't change, and how much they actually make up. So that's why that's getting such a lot of publicity right now. Obviously, the next budget isn't till October, so we'll find out then. And no doubt I'll talk more about what the latest views are as we head towards October. So that's it for today. That's the latest with the Bank of England base rate change and the difference it makes. Quick update on the UK economy. Look forward to seeing you again soon. Thanks very much for watching, and bye for now.